An ARM is an adjustable rate mortgage, which means the interest rate can fluctuate over the life of the loan. The starting rate is commonly referred to as the teaser rate and is typically lower than a fixed-rate mortgage, which can make it a great option for some borrowers. It's important to understand how your ARM works, as the initial low rate doesn't last forever. After the initial period, the rate and payment can fluctuate, which can make long-term budgeting more complicated. Here's how an ARM works. The loan term is split into two distinct periods: the fixed period and the adjustment period. The fixed period is when your initial rate is secured for a period of time, typically for the first 5, 7, or 10 years of the loan. During this time, your rate and payments do not change. The adjustment period is where the rate can fluctuate based on the terms of the loan. The fluctuation will depend on the index your loan is tied to, as well as the margin your loans dictate. A margin is a percentage over the index rate and varies program to program based on guidelines, your credit score, and other factors. This is set from the beginning. You'll know all the terms of your ARM before you close. Let's look at an example. If your rate is tied to the Secure Overnight Finance Rate, also known as SOFR, the index is noted on the adjustment date. Let's say the index is 2.08% on that day. Then your margin is added. For our example, we'll use 3% to make a note rate for that adjustment period of 5.08%. Your payment will change to reflect that rate and will stay fixed until the next adjustment period. It's important to note that your adjustment periods are limited to however often your loan terms dictate, most often 6 or 12 months, and your rate adjustment is capped at a certain level so that it can't increase more than a specific amount per adjustment. This keeps the rate and payment fluctuation more manageable. In addition, all ARMs have a lifetime cap, which means no matter what happens in the market, your rate cannot exceed a certain percentage over your starting rate. For instance, if your starting rate is 2% and your cap is 5% for the life of the loan, the highest your rate can go is 7%. So, you may be wondering, who uses an ARM and why? There are lots of reasons, including easier qualification, which can get many buyers into the home they want, especially if fixed rates are higher than ARMs. Another reason to take advantage of an ARM is if you don't plan on staying in your home or the loan for an extended period. For example, if your rate was fixed for the first 7 to 10 years, it would make sense to take advantage of that lower rate if you plan to sell before the first adjustment period. Want more information specific to your goals and qualifications? We're here to help, and we can show you a direct comparison of your options, including an ARM if you'd like to investigate further. Let's connect today.